Hey, this is Tim, licensed loan officer, MLS number 1866731. Welcome to my channel. Today we have a great video. We're going to discuss rehab loans. Homes that need work and how to get those repairs done and finance that home. Also, this channel is all about first-time home buyers, all about people that want to be property investors, loan officers, realtors, people that want to build their credit, build equity and wealth through home ownership. So if you're into that kind of stuff, if you like real estate, consider subscribing to this channel. All right, let's get into it. All right, so we're talking about rehab loans. And there's two types. There's 203K and there's a 203B. Now they're really similar, but the 203K is for people that the home is kind of need a lot of repairs, and the B is for homes that do not need as many repairs. Okay. So really quick here, we're going to talk about what is a renovational loan? What is it? So not every home is move-in ready. Some homes need a little bit of funds to, get it up to code, make it safe, make it livable. And that's when rehab loans come into play, because not every home is move-in ready. It also, right down here, eliminates the need for a second mortgage or a refinance to pay off a construction loan. So the way it works is usually if a home needs a lot of work, people will borrow against that home, and that would be called a second mortgage, because you have your first mortgage and then you have another mortgage that you use to make the repairs. But with a rehab or a renovation loan, it's all in one. So it's a lot more simpler and straightforward. And over here, it's a single loan for financing the mortgage, repairs or upgrades, and complete home value. So you're going to have money for the home, for repairs or upgrades. And that's what's beauty about that. And also, it allows you to personalize home improvements and make additions to the current home and make it move-in ready. And then you can save on real estate costs. So you do save on real estate costs when it's just one big loan that includes the improvements or additions or whatever you want to do. Because if you do two loans, you're going to pay closing costs on both loans. So that's basically what a renovation loan is. It's a loan that's for a home that's not move-in ready, that needs a little bit of upgrades or repairs, just to get it, where you want it. So the power of a renovation loan is that we have seen this all over TV. HGTV has several shows, whether it's a fix and flip. There's also renovation TV. So we have seen this, the Old Home, Property Brother, the list goes on. So there's a lot of different shows where people have now seen that you can take a home and totally gut it out and transformation that home. And I put a picture here. So, here's a home, how it was, and look at it. Here's a home. So here's a home here. This is how it was, and this is now. Wow. Same thing here. This is a kitchen here, older kitchen, and look at it now. This is a bathroom all gutted out, and look at it now. So that's the power of renovation loans. It literally could take a home that looks old, outdated, and then paint it and fix it up. And look at it. It's night and day. So the average cost, of these things, I think this is a little high. It's saying additional bathroom is around $104,000. I think that's a little high. To remodel a bathroom is saying about $40,000. To me, that's a little high too. That's a little high. To add a deck, around $17,000. To replace a garage door, $4,300. To do a major kitchen remodel, $77,000. To replace a roof, $29,000. To add a master suite addition, $157,000. Now these are national averages, and it says it's mid-range. I think these are a little high. I know the labor costs a lot. If you ever go to Home Depot to buy some supplies, are not a lot of money, but usually the labor costs a lot. But these are just some ballpark numbers that I found online that it would cost. But remember, with the renovation loan, all this stuff can be fixed. So you can do like add a bathroom, remodel a bathroom, put a deck, do a major kitchen remodel, things like that. Now, the good thing about these loans is that it adds opportunity for equity. And just got to give you a couple of examples here. So we have a home in Chicago, and the sales price is $335,000, and it needs about $125,000 worth of work. And if they do the work, which is the repairs of $125,000, that home is now worth $685,000. Wow. See, so that's how it works. If you just do a little bit of work with a rehab or renovation loan, it's instant value. Here's another example. This is in Oregon. The sale price is $330,000. It needs $28,000 in repairs. And if they put the $28,000 in their repairs, the home is now worth $400,000. So they bought it for $330,000. It's worth $400,000, and that is $41,000 of equity. So that's how that works. Sometimes homes that need a little bit of love, needs a little bit of repairs, a little upgrade, a little fixing, and then it's instant equity. Okay. And one more example, and then we'll be done here. So Dallas, Texas, you find a home for $295,000. It needs about $29,000 in repairs. You go ahead and do the repairs. And after repairs, that home is worth now $340,000, and you paid $295,000. Now you have $15,000 in equity. So a lot of times, if you can just do the work and get the repairs done, that home is worth a lot more. And that's something you need to consider when you're out looking at homes. Like, does this home have potential? Does it need a little bit of love? And that's what happened with my first home. It just needed a little bit of love and work. And I can show you before and after picture, and it's like night and day, night and day. And let's just talk about how a rehab loan is calculated. So we have a loan to value, loan to value, and then they go off of the sales price or as is plus repairs, or they give you up to 110 of the appraised value, and it cannot exceed 110. So that's kind of how it calculates. They're going to either use the sales price or the appraised value plus repairs, or let you go up to 110 loan to value. So they're going to let you borrow more than what the home is worth. Normally, loan to value, you can't go over 100% because that's 100% financing. But that's how it works. They're either going to do those two. And let's see if I have an example. Yep, I do have an example for you. So here's an example. And let's just zoom out of it. You see this okay? So we have a loan to value of 96.5%. The sales price is right here, $220,000. Now the labor is going to be $30,000. And some contingent, some more costs here. So all together, the labor, parts, and everything, and to buy the home is $254,000. And as the comparative value is $280,000, so the value of this will be $308,000. So the $308,000 would be the max you could borrow for this $212,000. And to qualify in guidelines for a rehab loan would be is nothing really extra. That's the beauty. It's still a 580 credit. Ideally, you want a 620, but as low as 580. The down payment is still 3.5% down. The debt to income, your max debt to income, this is the max, 56%. Ideally, you want this around 45%. 2 years of work history. And the home needs at least $10,000 or more in repairs. So at least $10,000 more in repairs. That's how you qualify for a rehab loan. So it's not much different than qualifying for a regular mortgage. And some things that are property eligibility. This is eligibility for 203 FHA. Now these are eligible homes. Eligible will be a single family or PUG, a FHA approved a condo, two or four units. You have to occupy it. So this means occupy only means it has to be your primary. It can't be an investment, anything like that. Manufactured homes are eligible for non-structured loan with a max $50,000 or 50% of the completed appraised value. So things are ineligible. So these are ineligible. X, you can't do. Mixed use property in a commercial zone. So it cannot be a commercial zone. A non-FHA warrantable condo. So that means that FHA cannot insure that condo. It can't be a timeshare. No working farms or anything like that. That's commercial. Same thing, commercial. No condos. Oh, condos. So those are like condos, but like they're hotels. They're kind of weird. Cooperative, unfinished construction. So those are things that are ineligible. But generally speaking, a lot of single-family homes are one of the most popular homes in condos. So pretty much any property could be eligible. And the way it works is that you get draws, okay? A draw. A draw means after the work is done, they expect the work, and then they give them the money. So that's how it works. You get up to 5 draws. A fund are disputes as work is completed. Each draw will have a 10% holdback, and then a HUD consultant determines the number of draws. So a HUD consultant is someone that works for HUD. That's the housing authority. They work really with FHA and things like that. They do a little bit with conventional too. But they will come out and consult, and they basically just help you. Make sure you're not getting taken advantage of. They'll determine number of draws. And the reason they hold 10% back is because sometimes things cost more than they expected. So they hold a little bit of money back. And just in case if things run over, they have a little extra money. They don't want to give you all the money. They hold a little 10% back just in case to protect you if things get a little bit more expensive towards the end because they want the project completed, okay? A lot of times, as you know, when you start a project, unexpected things happen. It's kind of like an onion. You just keep peeling it. All right, what's the next slide? So eligible improvements. So these are eligible improvements, and it's not all inclusive. So it could be something that's not on this list. So we can do kitchens or baths. We can do purchase installation of appliances. Okay, we can do repairs of roof, gutters, replace plumbing or electrical, replace deck or patio or porches, windows, external, internal siding, health and safety, that could be air or something, repair heating, ventilation, air conditioning, AC, flooring, internal painting, energy efficient improvement. So this all right here is a lot. So pretty much everything, roof, siding, all kinds of stuff, okay? And then some ineligible improvement. Ineligible would be like the structure. So they're not here to fix the structure of the home. The structure is like the foundation. Also, they're not going to improve any changes that are not approved in the scope of work. So they're going to do a scope of work, and they're going to follow that plan. Also, material must be ordered prior to the first draw. So they have to order supplies and stuff before the first draw. You can't ask for a draw, then order it, okay? They're not going to do any landscaping. A lot of that stuff you can do yourself. They're not going to do any recreational or luxury items. Again, this is ideally to get the home up to code and livable. It's not for luxury, okay? Again, no landscape, driveway, sidewalk, no tree treatment, no oil tank, and things like that. So that's pretty reasonable. I think that's reasonable. What do you think? And then some more ineligible improvements. You can't tear down the whole home. Okay, you can't demolish the home. Okay, again, no foundation. You can't move the home to another location. This stuff's pretty basic. Yeah. And then let's talk about timing and occupancy. So the construction must begin, within 30 days of closing. So after you sign all your paperwork and, give your down payment and everything, get your keys, it has to start within 30 days. It also has to be completed within 6 months. So it can't go more than 6 months. So after 6 months, all the work has to be done. The borrower may be displaced up to 15 days in 6 months. Again, so that means you have to live somewhere else as the work is being done. And then borrower paid material. So material provided by the borrower may be allowed but cannot be financed into the loan amount. So if you're going to do one of these, you don't want to pay for things out of pocket because you're not going to get your money back, okay? All materials provided by the borrower must be new from the manufacturer and documented with invoices. Ideally, I recommend you not buying anything if you're doing a 203K or 203B or renovation because it's all going to be wrapped in the loan. You're going to have a licensed contractor. They're going to get the supplies and they're going to take care of it. So it just let you know that you don't need to go purchase supplies. And if you do it, there's a chance you may not get paid, okay? So I want to give you some quick tips here. So some quick tips is the purchase contract. We said that a signed PA must mention the 203K or B in the financing. So when you find a home and you see it needs a little bit of work, make sure you put that in the purchase contract that you're going to be doing a rehab loan and you're going to be doing some work on it. Acceptable actual purchase contract or addendum. So addendum means that you have a purchase contract, but you want to change something. So you do an addendum. That's an addition to that purchase contract. And then you sign it and the seller sign it. And have access to the property for contractors, HUD, consultants, inspectors, architect, engineers, appraisal. So you want to have access to the property. Ideally, you want to have access to the property a little bit before you sign the purchase contract and things like that, so you can see everything, do your final walkthrough. Also, you want to make sure the water and utilities are turned on at the time of the appraisal. The appraisal is important because lenders use the appraisal. Also, the rehab company is going to look at the appraisal just to kind of see what they're seeing, and then they're going to make sure it meets those guidelines. The appraisal is something that lender wants to finance it, so just make sure that stuff is turned on for the appraisal. Also, contractors must be licensed and insured, and bond, and meet certain FHA standards. So the person actually going to do the work needs to be licensed, so a licensed builder, licensed contractor. They need to have an insurance bond, and they need to have some kind of knowledge of what FHA requires or conventional rehab requires, okay? That's the loan program. I hope this helps. I hope I went a little long, but there's a lot of information. There are some things that I did not include, but if you have questions about rehab loans or you just want to know, drop me a comment or contact me. I would love to answer the questions for you. Thanks so much for watching. And remember, subscribe to this channel. I'll see you again on next video. Thanks.